We complete our discussion of outbound taxation of electronic commerce with a look at the foreign tax credit. Here are the objectives of this lecture. To understand the U.S. approach to taxation of worldwide income of U.S. taxpayers, understand the potential for double taxation of income, understand the basic rules for calculating the foreign tax credit, and understand the special rules for sourcing income where there is a tax treaty. Let's begin with the U.S. approach to taxation of worldwide income of U.S. taxpayers. The United States claims the right to tax the worldwide income of U.S. companies, which includes U.S. domestic corporations and companies operated by U.S. citizens or residents. Such taxpayers are taxable in the United States on their worldwide income, regardless of the nature or source of that income. Income from the outbound transactions of U.S. taxpayers, that is, transactions involving foreign source income, is taxable by the United States regardless of whether such transactions are executed electronically, using the internet, or through conventional channels. The taxation of worldwide income is based on U.S. tax rules, but is subject to the provisions of U.S. tax treaties. Let's discuss the potential for double taxation of foreign income. The same income may be taxed in both a foreign country and the United States. As discussed in previous lectures, foreign countries can tax the business profits and non-business income of a U.S. taxpayer. As discussed in the previous slide, the U.S. also taxes the worldwide income of U.S. taxpayers. Accordingly, there is the danger of double taxation. The U.S. foreign tax credit was enacted to eliminate or reduce the potential for double taxation. It does this by allowing a U.S. taxpayer to reduce its tax by a credit equal to the U.S. tax imposed on foreign source income when that income is also subject to foreign tax. Here's how the credit works. A U.S. taxpayer calculates the pre-foreign tax credit U.S. tax it pays on foreign source income. It compares this tax to the foreign income tax it pays on this income, and then it takes a credit for the lesser of the two amounts. Here's an example. Webco, a U.S. corporation, has net $1,000 of income in country A. This income is deemed to be foreign source income under U.S. tax rules. Webco pays $210 of U.S. tax at 21% on this foreign income. Webco pays $400 of country A income tax on this income. The foreign tax credit is limited to the lesser of the pre-foreign tax credit U.S. tax paid on the foreign income of $210 or the foreign tax paid of $400. In this case, the foreign tax credit is limited to $210, even though the $400 in foreign tax was actually paid. As an alternative to the credit, there is a deduction of foreign tax. In lieu of a credit, a taxpayer can take a deduction for foreign tax paid. Sometimes a deduction for foreign tax is worth more than the credit. For example, a U.S. corporation has an $800 loss in country A and a $1,000 of income in country B for a net of $200 of foreign source income. Assume that in country B a $400 tax is paid on the $1,000 of country B income. As noted earlier, the foreign tax credit is limited to the pre-foreign tax credit U.S. tax paid on the net foreign source income. Assume that the U.S. tax is at a rate of 21%, and the U.S. tax on the net $200 of foreign source income is $42. Accordingly, the foreign tax credit is limited to $42, even though $400 in foreign tax was paid. This company may gain a better after-tax result by taking a U.S. tax deduction for the foreign tax paid, which is permitted to do. Assuming a U.S. tax of 21%, a deduction of $400 in foreign tax paid should yield a tax benefit of $84, twice the amount of the foreign tax credit. However, this is not the end of the story. As explained in the next slide, any unused foreign tax, that is, foreign tax that has not been offset by a U.S. credit, can be carried over or back to be used in years in which the taxpayer has foreign source income. The ability to take the credit in another year has to be weighed against the immediate benefit of a deduction for taxes paid. Here are some other rules for the basic credit calculation. First, if the U.S. tax credit is less than the foreign tax paid, then the excess foreign tax is carried over or back and may be credited in other years. In the previous example, where the tax paid was $400 and the credit was $42, the $358 excess can be carried forward or back and used in calculating the foreign tax credit in the carryover or carryback years if the taxpayer chooses not to deduct the tax paid. Only foreign income tax is available for the credit. Other taxes, such as excise tax or value-added tax, cannot be used to calculate a foreign tax credit. If there's a tax treaty involved, then the tax treaty itself may define foreign income tax for purposes of the credit. Special income sourcing rules apply when there's a tax treaty. If a U.S. tax treaty allows a foreign treaty country to tax an item of gross income derived by a U.S. resident, then the treaty may also define that income as foreign source for purposes of the foreign tax credit. This provision of a tax treaty will override any U.S. rules that might characterize the income as other than foreign source. Compare this rule to the general U.S. tax rules applicable to income sourced in non-treaty countries, which characterize income as foreign source or not using U.S. domestic rules, regardless of whether the income is taxed in another country. For example, a non-treaty country may tax income earned by a U.S. company, but that same income may be considered U.S. source under U.S. law. Let's look at an example where there is a disparity in the way income is sourced in a non-treaty country. WEBCO, which operates only in the United States, provides online services to customers in country A. Country A is a non-treaty country, that is, the country does not have an income tax treaty with the United States. Assume country A taxes the income earned. However, under U.S. tax rules, the income from WEBCO's online services is sourced in the United States because all activities related to the services are performed in the United States. In this case, there is no foreign source income despite the fact that the income is taxed by country A. Because there's no foreign source income, there is no U.S. tax credit, and the income is taxed in both the United States and country A. If there's a tax treaty between the United States and country A, and if the tax treaty defines as foreign source income any income subject to income tax in country A, then the threat of double taxation is eliminated. This is because the treaty would likely treat any income taxed in country A as foreign source income.